Hi, this is James Shug with Westpac London's end of day report for Wednesday, the 6th of March. It was a mixed day on equities today. Difficult to really discern any sort of fresh direction after multi-year highs were achieved on most markets yesterday. There was a range of data released which is of interest. The private payroll measure that ADP put out each month for the US posted a 198,000 gain in February. January was revised up to 215,000, so a decent pace of jobs growth in the first 2 months of the year on that index, although down from 276,000 in the November of last year. And indeed, a year ago, this series was running consistently for 4 months actually, outcomes between 250 and 300,000 per month. So the sort of turn of year upswing in ADP at the start of 2013 isn't quite as impressive as what we saw a year ago. I mean, it might sound like I'm trying to find bad things to say about the data, but certainly there is a sense, looking at the figures, that although the numbers sound relatively strong, and certainly they were stronger than expected, there is an element of concern that maybe there's a seasonal distortion driving these numbers. You tend to get strength in the start of the year, and then they fall on a hole around the middle of the year. And that downtrend that's emerged since November does seem to be consistent with that. So we'd caution that all is not well in the US labour market, notwithstanding these reasonably strong-looking numbers. Bank of Canada held interest rates at 1%. No surprise there. They tweaked the statement a bit, but basically they're saying that the considerable monetary policy stimulus currently in place will likely remain appropriate for a period of time, after which some modest withdrawal of that stimulus will be required. So they've got a very, very, very mild tightening bias, but not indicating that interest rates are going to go up in Canada anytime soon. In Europe, we had the confirmation of the fall in GDP in the fourth quarter of last year of minus 0.6%. Revisions to the data too now make it absolutely clear that the recession in Europe is already 5 quarters long, with the first quarter of 2012 previously reported as flat, actually now reported as minus 0.1%. So the recession is already as long as the recession in 2008-2009, although nowhere near as deep. Unlike 2008-2009, this recession doesn't seem to have any end in sight, however. That's about it in terms of the main data flow today. As I said, markets aren't much to write home about. We've got the Dow at the moment up 0.25% at 14,286. The FTSE closed down 0.1%. The French down 1/3%. The Germans up 2/3%. The Spaniards down 3/4, and the Italians down 0.5% today. Commodity prices. We've got an oil price decline of just over 1%, $89.80 a barrel. Copper's down 2/3%, and there's a 0.2% rise in the gold price to report. It's at $1,578 an ounce. The Aussie dollar's a bit lower. It's fallen about 0.5% or so in the last few hours of trading in the London session. It's at 1.023 at the moment. It was closer to 1.03 in the London morning. We've got Australian trade figures coming up for January. They're expected to show a very small deficit on our forecasts. Of course, we had GDP yesterday, Australian time, confirmed at 0.6% in the latest quarter, and the January figures on trade that we're going to get today will give us an early clue to the contribution that net exports might be making in the current quarter. Okay, we've got the Bank of England and the European Central Bank to watch for tomorrow. Both very interesting. The ECB press conference certainly is going to be a testing one for Draghi, and there's some speculation that the Bank of England could put in place some further stimulus. Not our view though. All right, back tomorrow.